Good day, everyone. I am Jadidaya Irivilla. So, to further discuss the subtopics of financial literacy, first let's talk about life insurance. What is life insurance? Life insurance is a type of insurance that compensates beneficiaries upon the death of the policyholder. The company will guarantee a payout for the beneficiaries in exchange of premiums. This compensation is called death benefit, which means a contract between an insurance policyholder and an insurer or assurer in which the insurer promises to pay a specified beneficiary a sum of money upon the insured person's death. Other occurrences such as terminal sickness or severe illness may also trigger payment depending on the contract. So the following are the common risk categories. So the first one is Preferred Plus. According to Preferred Plus rates are only available to applicants who are in good health and pose the least risk. Finally, the underwriter considers the likelihood that you will die during the policy's terms, with the healthiest, lowest risk persons having the greatest life expectancy. If you're in a good health, don't have a family history of cancer or heart disease, and don't often jump from great heights, you'll almost likely fall into this category and receive the lowest possible rate. So the second one is preferred. According to Preferred, if you are generally healthy but have one or two health risk indicators that underwriters deem red flags, such as untreated high cholesterol or high blood pressure, you will likely fall into the recommended category, which is a harmful lifestyle factor could also reduce your desired plus rate to favored. So the third one is Standard Plus. According to Standard Plus, you will be eligible for Standard Plus because if you have one or two medical concerns but are otherwise healthy, you'll pay more with Standard Plus than with Preferred Plus. But you won't be in the bottom tier with the highest rates. So the fourth one is Standard. If you have a number of medical problems or lead a higher risk lifestyle, you will most likely be assigned to the standard rating class. This means you'll pay a higher premium than healthier or lower risk applicants while still being eligible for a standard life insurance policy. So the fifth one is substandard. According to substandard life insurance is a type of life insurance that is provided to people who are deemed uninsurable at standard rates due to their poor physical condition, a medical history of major illness such as heart disease or other comparable causes. Because it is an extra risk policy, policyholders must pay a greater premium than they would for a normal coverage. So the last common risk categories is smoke. If you smoke, you're probably well aware of negative effects it can have on your health. According to the Centers of Disease for Disease Control and Prevention, cigarette smoking is the leading cause of the preventable disease, disability, and death in the United States. Each year, smoking causes 480,000 deaths, or 1 in every 5 deaths. Other unfavorable side effect of smoking is significantly higher life insurance rates when compared to non-smokers, who are smokers can pay nearly 4 times more for a life insurance policy. So let's proceed to benefits of life insurance. So the following are the benefits of life insurance. The first one is it pays for medical and funeral costs. According to this, life insurance pays for our medical and funeral costs, like for example, PhilHealth. They are the one who pays our medical expenses whether in public or private hospitals. If you are a member of one of if you are a member or one of your family member are member of PhilHealth insurance, they are also funeral costs like St. Peter funeral. It is a monthly payment depending on the services you get. The higher the investment, the higher the quality of services. These insurances can use when you pass away or when one of your family member passed away so they can use it. So the second benefits life insurance is for financial support. For financial support, life insurance can be financial support. For example, your husband is having a life insurance, but a few months ago, your husband passed away, and all the benefits of his life insurance will be claimed by his wife, not only for financial support for the funeral, but also for another benefits financial support in other category that parts of the insurance he get. So the third benefits of life insurance is for funding various financial goals. So here, for example, is the retirement plan, educational plan, multi-purpose or investment fund. These are the financial goals that supports when it comes to financial, that part of the life insurance benefit. So the first benefits of life insurance is acts as a retirement secured conform. So here, this kind of life insurance benefits. Retirement is one of the coverage of it, like pensions after your retirement and turning senior age. So you can get retirement fee and also monthly or yearly pension that can support your financial needs. So the fifth benefits of life insurance is it covers costs incurred from taxes and debt. According to the fifth benefits of life insurance, one of the example of this when it comes to the real estate support and or collateral. Like you can pay your housing investment, your insurance can cover it or you can transfer it to your insurance so that they will pay it for you. But if you passed away while paying your house investment, the insurance will get it as a collateral. So let's move on to the type of life insurance. So the table shows a comparative analysis of different types of life insurance along characteristics, advantages, and disadvantages that may serve as our reference. So this is the table for type of life insurance. So the table shows a comparative analysis of different types of life insurances like characteristics of life insurance, advantage and disadvantages. So the first type of life insurance is endowment, and its characteristics is it grants a lump sum after a specified amount of time or upon death. The policy owner is required to pay the premium for a predetermined number of years or until a specific age is reached. So according to this, an endowment policy is a type of life insurance that pays out a lump amount after a set of period of time or upon a death. Up to a particular age restriction, typical maturities are 10, 15, or 20 years. In the event of a critical illness, some insurance will pay out. So traditional with profits or unit-linked policies are the most common. So the advantages of endowment is it allows for saving up for specific purposes. It guarantees return upon maturity. It offers some form of insurance coverage. So according to this advantage of endowment plans allows you to save money in systematic method for your future financial requirements. And an extra benefit is the life risk insurance, which would be quite beneficial to the family if something unfortunate happened to the primary breadwinner. The returns may be lesser, but in the case of a certain sum insured, they are almost always risk-free. So the disadvantages of endowment is requires higher premiums than other types of life insurance. It is not the best option for those looking at full life protection. So the disadvantage of endowment is the following are some of the disadvantages that only offers protection for a limited of time. The cost of wildlife or term insurances is typically substantial greater. So the second type of life insurance is term. Its characteristics is the simplest form of life insurance to obtain, of which upon death the beneficiaries are paid with the benefit. So according to term, insurance is a type of life insurance that is solely for the purpose of providing protection. It gives coverage for a set length of time in exchange for a set premium. The insurer gives a guaranteed compensation if something unpleasant happens during this time span. It compensates your nominees for your income lost. So the advantage of term is entails low premium requirements. It is a strong option for policy holders who need insurance but cannot afford whole life or endowment, and it is easy to understand. So the advantage of term, it is provides protection for a certain period of time. Term life insurance premium are less expensive than than whole life insurance because you will outlast the term and the policy will expire. The life insurance company is hoping to never pay out. The disadvantage of term is it has no benefit if policyholders outlives the term period set. Premium usually gets higher upon the renewal of terms. So according to this, its disadvantages is it only a short-term solution. It requires requalification at the end of the term, having difficulty to qualify if you have a serious health problem. So the third type of life insurance is whole life. Its characteristics is it provides coverage for the policyholders entire life or until they reach 100 years old. It acts both as protection and savings mechanism since a portion the premium is allocated to build up cash values. So according to its characteristics of whole life, it is also known as whole life insurance. It's a type of life insurance that is guaranteed to stay in the force of duration of the insured's life or until the maturity date, whichever comes first. So the advantage of whole life is it offers permanent protection for full life or 100 years. It is flexible in terms of payments of premiums. It entails fixed premiums. It usually comes with additional features and living benefits. So according to advantage of whole life, it is being a perpetual coverage. It designed to give you with comprehensive protection for the rest of your life, with premiums that won't go up, won't expire after a set of number years, and can be cancelled due to illness or health. The disadvantage of whole life is it requires higher premiums. It is difficult to understand due to complexity. So the disadvantage of whole life insurance is much more expensive than term life insurance, which premiums or with premiums ranging from 5 to 15 times more. Furthermore, the cash value component of the account does not provide as high as a return as a regular investment account. So, the last type of insurance is vulnerable universal life. So, its characteristics is serves as both life protection and investment vehicle in one package. A portion of the premium is allocated into various investment vehicles for the purposes of wealth creation. So, the contract's earnings are based on the performance of selected investment. So the characteristic of vulnerable in universal life is permanent life insurance, often known as universal life insurance. It is a type of a permanent insurance. It is a universal policy covers that insured person for the rest of their life as long as they pay their premiums and follow the policy other criteria. So its advantage is it takes dual purpose life. It is a two-in-one life insurance and investing instrument. It has no age of maturity. Along with the promised sum, the cash value is due. The debt component isn't just about the money. It represents liquidity or the ability to obtain cash in times of need and serve as emergency finances. So the last one is the disadvantage of vulnerable universal life. It means dividends and cash values are not guaranteed. The amount of the face amount and the death benefit are both determined by investment performance, and various investing costs are included. So these are the types of the life insurance that we must be familiar with. So let's proceed to the next subtopic, which is financial stability. Financial stability is not about being rich, but rather more of a mindset. It is living a whole life without worrying about how to pay the next bill and becoming stress-free about money while focusing energy on, on, on other parts of life, according to Silva 2019. It is something about that no one worries about his or her bills, debt, or in any kind of payables. It is about saving investment. So it will help you to support your financial by saving money like banking purposes. So in using that, it will secure money and will avoid and lessen to buy or purchasing something. Like anyone else, teachers also aim to become financially stable, if not today, maybe in the future. Being financially stable means confidence with the financial situation, worryless paying the bills because of available funds, debt-free, money savings for future goals, and enough for emergency funds. So here are the 10 strategies in reaching financial stability. The first one is making savings automagical. According to this, saving money is a must so that you can use when the time comes that this will be needed in the future. Deposit money as you're saving in the bank to make it secured, and using that it will give you an interest and other benefits, life insurance. The second one is control your impulsive spending. It controls because of the assurance of your money will not waste instead of spending to the other things. Why don't you save it and get an insurance so that so that your money will not waste and it will use to important like medical expenses and etc. So the third one is evaluate your expenses and live frugally. So according to this, know your wants and needs. Spend the money only in the essential things, not to the unessential thing. So the fourth one is invest in your future. According to this, invest for yourself like saving money for your educations. House loan investment for the family to make your family secured. Investing for land and properties for the future for you if you want to build a business. So the fifth one is keep your family secure. So according to this, keep your family secure through financial support so that if you need money, saving investment will help you. If you need medical assistance, medical insurance will help and for funeral having an insurance, it will help you to support your expenses and etc. The sixth one is eliminate and avoid debt. According to this, eliminate and avoid debt. Insurance helps you to avoid debt using because having of it will support your expenses like in medical or funerals. So in that thing, it will help you to do not worry about paying your expenses. The next one is use the envelope system. So according to this, it is about budgeting purpose. So in that way, securing your bill in envelope or separating your bill using the envelope is to secure or to avoid spending to other expenses like you know where your money to use for or to pay for. So the next one is pay bills immediately. Paying bills immediately or in advance for you to do not think about what bills you need to pay in the due date. It helps you to lessen the demerit of your bills like additional penalties and to have also incentives to use. So the next one is to read about personal finances. According to this, you spend it on your own personal finances like your needs or wants or what is the most important thing to you. So the last strategies in reaching financial stability is look to grow your net worth. So according to this, like for example, buying properties for investment like land, the longer it takes, the higher the interest it produces high value price if you will sell it. So let's proceed to signs of being financially stable. Teachers, like anyone else, often work to the extent of earn even through additional jobs on the side just for their desire for financial stability. So I will present the 20 20 financial 20 signs of financially stable person. So the first one is you never overdraw your checking account. Second, you don't lose sleep over finances. Third, you use credit cards for convenience and rewards but never out of necessity. Fourth, you don't worry about losing your job. Fifth, you pay your bills ahead of time. 6. People ask your opinion about financial matters and you inspire them. 7. You're generally happy with your financial situation. 8. You finance your cars over years or less if you take loans at all. 9. You contribute more to your retirement. 10. You don't feel guilty when you're out for special occasions. 11. You can afford to buy the things you really want that appeal to you. 12. Recreational spending doesn't. 13. You're a natural saver. 4th, you're generous with money when it comes to charities or helping others. Next is you're confident about your future. The next one is your net growth significantly from year to year. 17. You have substantial equity in your home. 18. You consistently live benefit your means. 19. You could survive for months without a paycheck. The last one nga is you feel in control of your finances and never dominated by them. So these 20 signs that Rose represents help us to become knowledgeable on how we are spending our money for good and how we can manage things for the better future. So let's proceed to the last subtopic under financial literacy, which is integrating financial literacy into curriculum. So financial education in schools should be part of collaborative national strategy to ensure relevance and long-term sustainability. The education system and profession should be involved in the development of the strategy. So according to this, to ensure relevance and long-term sustainability, financial education in school should be part of national joint approach. The strategies formulation should include input from the educational system and profession. Financial education should ideally be a core part of the school curriculum. It can be integrated into other subjects like mathematics, economics, social studies, technology, and home economics, values education, and other subjects. Financial education can give a range of real-life context across a range of subjects. Teachers should be adequately trained and resourced, made aware of the importance of financial literacy and relevant pedagogical methods, and they should receive continuous support to teach it or integrate in their lesson. More so, there should be is a easily accessible, objective, high quality, and effective learning tools and resources available to schools and teachers that are appropriate to the level of study. Students' progress should be assessed through various with high impact modes. So to sum it all, financial literacy is defined as the ability to make well-informed decisions about the use and management of money. A financial plan is a detailed description of an individual's long-term security and well-being goals, as well as the savings and investment strategies for reaching those goals, based on the individual's current financial situation and future expectations. Budgeting is the process of formulating a plan to spend money, whereas a budget is a projection of income and expenses over a set future period of time that is usually compiled and re-evaluated on a monthly basis. If money is saved and invested, after considering the key aspects such as time horizon, expected return, risk tolerance, and investment type, it will earn more. It is also critical to save on a regular basis in order to pay off debt or purchase items we desire, as well as to have an emergency reserve in case of need. Financial fraud such as huge data breaches can happen to anyone at any moment. However, there are several ways to avoid financial scams such as phishing, social media and phone scams, stolen credit card details, and identity theft. Insurance is a contract between the policyholder and the insurance company in which the firm undertakes to compensate the policyholder for any financial loss resulting from particular insured occurrences regardless of the kind of insurance. Financial stability entails or trust in one's financial state, worry-free bill payment due to available finances, debt-free status, money saved for future aspirations, and adequate emergency funds. Last, financial literacy should be included in the curriculum from an early age as part of a coordinated national approach. So, thank you for listening. Hope you learned something from me. God bless us always. Thank you.